Hey everybody, welcome back to WhiteBoard Finance. In today's video, I'm going to smash buy $10,000 worth of SCHD. This is Schwab's Dividend Fund. It's an ETF that I've been investing in for about 2.5 to 3 years now. Basically, in this video, I wanted to piggyback off of my last video talking about dollar cost averaging versus lump sum. Historically, I've been a dollar cost average investor. We saw that the numbers mathematically, the phrase still holds true that time in the market is greater than timing the market. So basically that's kind of just an advocation for lump summing early and often and then just letting the market do its thing. So again, I've been a dollar cost average investor for many, many years because I know what I'm investing in. I know what my goals and principles are. And then also I want to stay disciplined by doing that. It's kind of just like working out Monday, Wednesday, Friday, Saturday, right? You know that you have to work out on those days. I know I have to invest, once a week, for example. So let's get right into it. This is my screenshot from a Robinhood account that I have. As you can see here, this is August 4th, 2020. This is actually when I started dollar cost averaging daily into SCHD. I think I had like a bunch of money and I just wanted to get rid of it. So again, I don't want to say too scared to invest, but I also remember when the market crashed 30, 40, 50% in 07, 08. So that kind of left a bad taste in my mouth. And then I've also been investing and studying financial markets for a very long time. If you remember Japan's Nikkei, if you invested $1 in 1991 into their Nikkei, you're getting that back, almost 30 years later, right? Just because it's been a flat market. So that's my Robinhood account. This is my M1 Finance account. I have about $4,000 worth of SCHD in here. I also started investing, as you can see right here, right around the same time, August 3rd, 2020. So let's get into the prospectus. So this isn't going to be an entire boring video reading this whole prospectus, but I noticed a lot of people, they don't really even know what a prospectus is. So how can you be investing in something if you've never even read the prospectus or even know what the investment objectives are? Like, what are you trying to do here? Are you just blindly, shoveling money into something because a YouTuber told you to? That's probably not the smartest thing to do. Or a bunch of people on Reddit like something, so you're just going to blindly shovel your money into it. No, that doesn't make sense. So I highly recommend, not just for SCHD, but for anyone investing into anything, especially something through a brokerage like, Schwab or Vanguard or Fidelity or, whoever, TD Ameritrade, whoever has their own products. You want to be careful and see how they actually manage this fund. So very, very quickly, I don't want this video to become boring or dry, but it is important to understand, what does this thing even try to be, or was it even trying to invest in? So the objective is, it's basically trying to track the Dow Jones US Dividend 100 Index. And the second most important thing that you can understand when you're looking at some of these funds, especially with like Vanguard or, the funds that I've been talking about for years on this channel, you got to look at the fees, because fees will kill you. So this one is actually very cheap. So SCHD actually comes in at 0.06%. Which is basically $6 in management fees for every $10,000 that you have invested. So in this quick example, they give you, if you invested 10 grand in the fund for the time periods indicated, and you sell all of your shares at the end of those periods, assuming a 5% return each year, you'd only be paying $77 at the end of a decade, right? So expensive funds can absolutely destroy your returns, especially when you consider after-tax implications and when you consider that your money is growing over many, many decades, 2-3 decades, not just, years or months, if you will. So those can really start to eat into your returns. And at 0.06, that's pretty much nothing. So I'm going to read this very, very quickly, because a lot of people, they go on like Reddit or they go on YouTube, and some of these people make, videos about, SCHD or whatever. It doesn't even have to be about SCHD, but they don't even know what the fund is investing in or what its objectives are. So very quickly. So as we mentioned earlier, it's trying to track the Dow Jones US 100 Dividend Index. So it's designed to measure performance of high dividend yielding stocks issued by US companies. They have a record of consistently paying dividends, selected for fundamental strength relative to their peers. So there's a whole bunch of criteria here, which I'm not going to go into, but it's important to understand that all index eligible stocks must have sustained at least 10 years of consecutive dividend payments, have a minimum of a market cap of $500 million. Remember my stock market for beginners video, market cap is simply just the share price multiplied by the number of shares outstanding. So if a company has 1,000 shares and each share is worth $1, that company has a market cap of $1,000 for simple math for this video. So they have to have at least 10 years of consecutive dividend payments, okay? So they can't have cut it, which is good. $500 million market cap. And then also they're selected by evaluating the highest dividend yielding stocks based on 4 fundamentals. That's cash flow to total debt, return on equity, ROE, dividend yield, and 5-year dividend growth rate. That's the kicker for me for SCHD. I had a tweet the other day talking about how a bunch of people on Twitter and stuff, and also on YouTube, they're very disingenuous when they talk about dividends because they never talk about inflation. They just talk about, oh, I got these dividends. Well, congratulations. If your dividend is 4% and there's no growth in the stock, there's no growth on the underlying, right? Think of it as a rental property that you get, X amount of monthly rent, but the property never goes up in value. Congratulations, you're getting crushed by inflation, okay? It's that DJ Khaled meme, congrats, you played yourself, okay? So what I'm trying to say is these people say like, oh, just invest in these dividend stocks, in 20 years from now, it'll be worth, 20 grand a year in dividend payments. Well, what's 20 grand in 20 years going to be? Nothing. It's going to be a third of a Toyota Corolla, okay? Toyota Corolla is going to be 50, 60 grand 20 years from now. And I'm exaggerating. That's tongue-in-cheek, but still, there's no purchasing power maintained. So that's why growth is huge for me, and SCHD has done an excellent job of that. So the other thing is no single stock can represent more than 4% of the index, and no single sector as defined by the index provider can represent more than 25% of the index as measured at the time of the index construction, reconstitution, and rebalance. So there's a bunch of other stuff that goes into this, but I don't want to bore you to death with this. But I just wanted to show you very, very quickly the last thing here, and that's the annual total returns. The nice thing is Schwab does a really good job of just showing you what this has done. Let me see if I can zoom in just a little bit more. Okay. They've done a good job of showing this as of December 31st, 2022. So if you look at, and I'll show you all this in Portfolio Visualizer when I back test this against the S&P 500 and also when I back test it against another popular Vanguard Dividend ETF. And then I'm also at the end of the video obviously going to buy 10 grand worth of this stuff, so hang on till the end here. But you can see here the average annual total returns as of 12/31. Oh, this is 21. I'm sorry. So this is actually a year old. My bad. Because this prospectus is actually from January of 23. So sorry about that. So basically you can see here you have the 1 year, 5 year, 10 year, and we're going to see all this in Portfolio Visualizer, so I don't want to beat a dead horse. But basically after tax distributions are very healthy. Past 10 years, it's 14.5%. And this is assuming you're in the highest tax bracket, okay? So most of the people watching this video probably aren't in the highest tax bracket. So these returns are actually be higher than what they're showing here. So this is a super strong, this is actually outperformed SPY, which we'll see here in the next slide. It's a super strong ETF. I've been buying it for years. I'm going to smash buy a little bit more just because I've gotten too much into the habit of dollar cost averaging. We're going to get into back testing this so I can actually show you the numbers and also what it really means after you adjust for inflation. Now, I'm not the only one who's making some changes to my portfolio as you're watching in this video. With markets going haywire, Morgan Stanley themselves just released a report just a few weeks ago with some great insights and strategies, especially with the Silicon Valley Bank failure and volatility in bonds, which were supposed to stabilize a portfolio. This gives you another way to potentially lower volatility because as this graph shows, for the last 30 years, a portfolio that included alternative assets would have had lower volatility and higher returns. This is part of a larger push into alternatives by big institutions, a playbook that lots of other investors are following according to Financial Times. But which alternatives to diversify into? There are lots of options, but I'd like to show you another report, this time from Barron's. It's on an asset that saw prices rise an average of 29% just last year, handily beating stocks. This asset was fine art. It's the same asset I've talked about for months that you can invest in with Masterworks, because not only did prices rise 29% last year, but Masterworks had 9 more successful exits in 2022, all of them delivering over 9.2% net returns. Obviously, art isn't going to be your whole investing strategy, but these numbers are super encouraging, and lots of my subscribers have signed up for Masterworks already. So to diversify, check out Masterworks at the link below. You'll get my special priority access. Okay, thank you for sitting through that. It pays for the production costs of this channel. So here's Portfolio Visualizer. If you haven't used their backtesting tool, I highly recommend you do this. Some of you have already seen this on my channel, so I'm not going to beat a dead horse. But basically what I'm doing here is comparing SCHD to SPY to VYM. Not 1000% apples to apples, but you get the picture. It's just to paint a picture of, hey, everyone tries to benchmark their performance against the S&P 500. Let's see how these two other funds have done over the last, I want to say 11 years or so. So the reason I say 11 years or so is because this only goes back to January of 12. Why does this only go back to January of 12? That's because SCHD was created in January of 12, or that's the information they have on SCHD, I should say. So if you want to zoom in, you can see right here, SCHD is first, SPY is second, Vanguard is third. So if you put in 10 grand in January of the date that we just talked about 11 years ago, you can see here that you would end up with almost $40,000 with SCHD. You're ending up with almost 39 with SPY, and you're ending up with 33,312 with Vanguard's VYM. And you can see the CAGR, you can see the standard deviation. So not only was SCHD the winner in absolute nominal terms, but you can see here that its best year was the best, and its worst year was the best too. So you're getting all the upside and none of the downside, relatively speaking. You can see that the max drawdown at any given time was 21.5%. It's almost 24% for both SPY and VYM. So here's the chart that you're all interested in. This is basically showing you all three of these securities compared to one another. Again, you can see the numbers are the same, but it's SCHD first, SPY second, VYM in a far third. The nice thing about Portfolio Visualizer is that you can click this button right here for inflation adjusted because it knows the CPI for each year. So remember, we're almost at 40 grand and 39 grand. Now look at where we're at. We're at 29,846 after inflation when adjusted for inflation. We're at 29,173 when adjusted for inflation, and just under 25,000 for VYM. So see how powerful inflation is, you guys? No one talks about this. People understand it, but they don't really understand how powerful it is. Look at these two numbers right here. We go from 39,787 and almost 39,000 for SPY, again, to not even 30,000 for both and 29,000 for SPY. So what I'm trying to say is all those videos and all the people that talk about, like, you know, your dividends are going to pay for this, they're going to pay for that. Yes, it's important to have that stream of income. Okay, I really do believe in that. That's why I'm buying 10,000 of this stuff here in the next couple minutes. However, you have to realize the underlying has to grow as well. And SCHD has not only grown their dividend to surpass CPI, it's also outperformed the S&P 500. So you can see with this bar chart right here, these are the annual returns for Schwab, which is blue, SPY, which is red, and Vanguard's VYM, which is yellow or orange, depending on the color on your screen. But you can see SCHD has held its own. I mean, it's outperformed in 2013. It's kept up in 2014. It's right around there in 2015. I mean, it's done a great job, you guys. And look at this. In 2022, SPY was down 18.17%, while VYM was only down 46 basis points, and Schwab was down 3.23%. So it's really held its own. And again, that standard deviation and also the lower lows of the S&P 500 and the lower highs of VYM, to me, makes SCHD kind of a no-brainer. The one thing I do want to harp on before I do get into smash buying 10 grand of this stuff is, obviously, history isn't indicative of future results. Everyone knows that. Otherwise, we'd all be rich, you know. Otherwise, you know, Cisco would still be at, you know, 70, 80, 90, $100 a share when it was like 70 in the dot-com bubble. Now it's sitting, you know, significantly under that, you know, 20-something years later. So don't take this as the end-all be-all, but you also have to go with the numbers, you guys. So with all this being said, not only has SCHD grown its dividend, it's also grown its equity position, its underlying share. So that's why right now we're going to, let me see if there's like a dramatic. we're going to buy 10 grand of it. So this is my Charles Schwab account. You can see right here, this is my taxable account. I have 100 grand in here ready to trade. You know, no more Mr. Dollar Cost Average. Let's just smash by 100 grand, you guys. Let's do it. No, I'm just kidding. I got a wife and a kid on the way, dude. Another kid, a year and a half old. Oh, I also got another video coming out. The banking crisis deepens. Actually, it should be out by the time this video is out as well. Watch until the end of that banking crisis video. I call my daughter on the phone. She's only a year and a half old, you guys. I'm like, who do you like more, the European Central Bank or the Fed? And she's like, hi. It's so funny, you guys. All right, so I'm going to do buy. I'm going to do market because I don't really care what I buy this at. The smarter thing to do, in my opinion, would actually just be to do a cash secured put. I have a video on cash secured puts. You can actually get paid to buy a stock at a discount, which I'm going to stay out of this video real quick. I'm just going to smash by 10 grand right here. But the better move, most likely, if you're not eager to let these dividends start compounding, is most likely to do a cash secured put. So market, we're going to do a little calculator right here. Let's say $10,000, 139 shares. There we go. Ready, set, hit the like button. Hit the like button when I hit place order. Ready? 1, 2, 3. Okay. Like, subscribe, do all that good stuff. Great. So we're good to go. So this has been confirmed. So we just bought 10 grand of SCHD. Hopefully you learned a little bit about it. This wasn't supposed to be some, you know, video getting into spreadsheets with drip and showing you what the returns are going to be in 10, 15 years and doing all that stuff. It's just to better understand what you're investing in, understanding the prospectus, the historical returns, and the fees. That's really all that matters when you're investing, you guys, in ETFs and index funds, not individual stocks. So hopefully you got value out of this video. As always, take a look at the link in the description below for WhiteBoard Finance University. It'll be a private community with access to me on a weekly basis through live streams. I'm an open book. I'll be teaching you about literally whatever you want to know. Getting a career in finance, how to land a job, all the other things that we talk about in the university. I'm basically like a mentor at this point because I feel like I have enough life experience with being, you know, a father, husband, parent, and then also, you know, I've had my whole career was in finance and commercial real estate. So it's almost like a mentorship, but really it's just going to be an ever-expanding library with access to 4 real professors. Real estate professor, he owns 400 units in Dayton, Ohio. Stock market CFA, Chartered Financial Analyst, very prestigious designation, not easy to get. A budgeting coach with personal finance lessons, and then also an ETF portfolio construction guy as well. Lessons, weekly live streams, all that good stuff. Check it out in the link down below. Thank you so much and have a prosperous day. I had to go casual on him today. My buddy got me this hat. Shout out to Nino, El Nino. He got me this hat for my birthday. I thought it was kind of funny. He bought me a hat with my business's name on it. I'm about to buy him a hat with his business's name on it. Here you go, bro. Oh, thanks, dude. All right, guys, have a good one. I'm going on vacation tomorrow. I'll see you guys in a week or so. Peace.